Good afternoon, everyone. I will begin my presentation with a perspective on IFRS to say that IFRS journey is still far from over from an Indian regulation perspective, and we continue to see kind of noises in between whether this is going to happen or not. So there is kind of a lot of uncertainty around eventual kind of transition to IFRS in the country. Many of you, may be tracking the discussion on companies bill, and today it is listed in the Rajya Sabha as well for kind of a discussion and hopefully the clearance of the bill as well. So we see that as and when possibly the company's bill is going to be a reality, we'll see much more action in the context of IFRS in the country. So what I've done is divided the presentation into 3 sections, for the benefit of the participants. So we're going to talk about 3 key IFRS which has recently been issued and which are now going to be mandatory from 2013 onwards. So these are the 3 standards. I will just try to give you a brief overview that what is the change which will result into financial statement, etc., etc. Then I'm going to talk about 3 proposed changes from an IFRS perspective. And they are a little distance in terms of the eventual implementation, etc., or finalization. But I think these are important developments, and I think we should keep a tab on it. And then, at the end, I will just try and quickly cover that where do we stand in terms of IFRS status in India, what's the current kind of roadmap, what is the status on Ind AS, what is the status on tax accounting standard. I just thought to give you a quick update on tax accounting standards, and then a quick thing on companies bill as it impacts accounting and reporting, which are towards IFRS. So we will try and cover that as well. As we said, if you have questions, please type in your question. I will look at them and we will try to address it in last 30 minutes of the presentation. So moving forward on IFRS 10, this is in the context of consolidation. So the existing standard in the IFRS is IAS 27, which talks about consolidation, and we have SIC 12, which talks about consolidation for special purpose entities. So what IASB is trying to do through this change is they're trying to incorporate all guidance in relation to consolidation of subsidiaries or your special purpose entities or a structured vehicle at one place. So that is what we've done through IFRS 10. So I will just kind of try and help you a quick perspective that what is the fundamental change. So first of all, the journey of IFRS 10 is there on the slide, which is on the left-hand side. So the standard was published in May of 2011. January 12, the retrospective application was allowed. We had transitional amendments published in June of 2012, and 1st January 2013 is the date of initial application, and 31st December 2013 is when first financial statements in which standard would apply. So for any Indian company doing IFRS with April to March as the year end, so possibly for them 31st March 2014 will be the year in which they will apply and present their financial statements in compliance with IFRS 10. So a key change under IFRS 10 is to have a single control model for all entities, including special purpose entities. So previous model of consolidation was largely related to risk and reward. So now we moved away to a little bit, in that sense, and trying to integrate the guidance which was there in IAS 27 and SIC 12 into one kind of common standard. What we are trying to say that consolidation should be relevant for that entity which primarily going to control the subsidiary. So just because you are the majority stock owner, but if you are not the decision maker for operation of an entity, then you should not be consolidating that business. So assessment of control is largely linked towards your ability to run the business, and that is where the change is very important. And lot of places where your ability to run the business is directly related to what are decisions which are important to the business, and who all can take those decisions. So who is actually in the driver's seat. So that at times is an easy determination, but sometimes it's a very complex situation where there are different stakeholders or a complex arrangement where you have somebody a veto right, somebody a participative right, somebody protective right, etc. So if you have multiple kind of combination being involved, then that situation often requires a lot of time to apply the standard to figure out who should be consolidating this, and that is where there is a substantive change. We don't believe that 90% of the existing structure will not result into any changed accounting for IFRS 10. So in other words, if it was a subsidiary prior under IS 27 or SIC 12 model, it possibly will continue to be subsidiary, a consolidated subsidiary in the IFRS 10 model as well. However, few structures which may not be consolidated previously, or they may have been consolidated previously, we may see some changes in terms of conclusion which are directly related to your ability to control all the activities which are relevant to the investing companies. I think that is where the big change is going to be. Who has the power to run the business in that sense, and that is so things around potential voting right, things around de facto control, interest in structured entities, all of that will impact your decision to consolidate or not to consolidate. So what are the key impact areas? Some of the investees previously accounted for using equity accounting or as financial instrument may require consolidation. So where we may have evaluated, we have concluded consolidation not appropriate, now we may need to consolidate as well. Some of the unconsolidated entities that have significant relationship with the entity may now require consolidation as well. And so accordingly, I need to look at my consolidation system and processes to make sure it continues to be in line with the requirement of new accounting standards. So that's where some of the change in IFRS 10. So it's a very important change. A lot of financial services company may get impacted because of this change. And if you have a lot of structured vehicles, then you need to be more careful about this standard. Similar to IFRS 10, ICAI has also issued IND AS 110, and the standards are largely similar to what is out there in IFRS 10. So we move forward to talk about another amendment which has happened for investment funds. I think this is a much welcome change in IFRS, which was always there in US GAAP. So this is applicable for investment funds. So for example, you are a private equity house, and let's say you purchased more than 50% stake in a business, all right? But the main objective for which you purchase the investment is to help the business grow and then exit in 5 to 6 years or 3 years or 7 years, whatever the time horizon of that private equity investor is. Because every private equity or any venture capital or any investment house, their objective is to invest the money and then provide return to their stakeholders, as opposed to keep on running the business forever in that sense. So wherever the objective are linked to investment and providing return on investment to the stakeholder, so the idea is, why do then I need to consolidate all my subsidiaries wherever I have significant interest? And that is where this change is going to provide a lot of relief to all the investment funds related kind of structure. So their business purpose is solely to earn return from capital appreciation and or investment income. So they have defined the the boundaries for somebody to be recognized as an investment fund. Entity measures and evaluate performance of substantially all investment on fair value basis. So what's important is that if you decide that I am an investment fund, then you no longer need to apply IFRS 10 or IAS 27 as the case may be. You can apply now this guidance and do accounting for all your investment, including your majority on subsidiaries, on a fair value basis. So that's a significant change. That's a significant change and a relief for a lot of companies, which will a lot of these fund houses, which will simplify to a large extent their own accounting and reporting requirements. So they can straight away do fair valuation in their P&L. The volatility, of course, it exposes P&L to a lot of volatility because fair value may go up or down, but that is the nature of their business. If you are investing in securities, it will result into volatility in your financial statement. So that is where the big change is. So what are the key impacts we see? Judgment required for qualifying criteria, that whether you qualify as an investment fund or not. Investment in associates and JV also required a fair value, mandatory exception for all qualifying entities, retrospective application on transition, fair value measurement question remains, and new disclosure, lot of kind of disclosures which are out there. So one needs to make this assessment, do the disclosure and the accounting accordingly, and this is mandatory from 1st January 2014, and you can look at early adoption as well from 1st January 2013 in that sense. So that's a very welcome change, as I see from an IFRS perspective. We move forward to IFRS 11 on joint arrangements. So this is a standard which was also in progress for a long period of time. So it was issued concurrent to IFRS 10. So with a similar kind of timeline to say January 2013 is the date of initial application, and 31st December 2013 is the date when you need to apply the standard. In that all your financial statements will include the results of the standard. What are the key changes? So if you just relate this to existing IFRS or existing Indian GAAP on joint venture accounting, AS 27 or AS 32, AS 31, sorry, what it says is that all joint venture, jointly controlled operations, etc. You can do two type of accounting. Either you do a proportionate consolidation. So under Indian GAAP, you can only do proportionate consolidation, whereas under existing IFRS, you can possibly do proportionate consolidation, or you do equity method of accounting for joint venture in that sense, or jointly controlled entities. Now, what the revised standard is saying, if it is a jointly controlled entity in which the obligations for liabilities related to arrangement are not extending beyond the entity in general, okay, then you are now permitted to do only equity accounting. So you are not allowed in future to do proportionate consolidation. Now this is similar to, again, requirement under US GAAP. So there is a kind of convergence which is happening here between US GAAP and IFRS, and some of these differences are going away in terms of the presentation. So for all joint venture entities, now you will be only allowed to do equity method of accounting, and no proportionate consolidation will be allowed. However, for joint operations, you will continue to recognize your own assets and liabilities. You will continue to recognize revenue and expenses to the extent you are liable, or to the extent you earned revenues in relation to such joint operations. So, and we need to very carefully evaluate where a joint venture entity, which in fact is a joint operation, or it should be a joint venture entity as such. What IFRS cautions us, that you should not simply go by the structure, and you should look at substance over form. So if in substance as parties continue to be exposed to all the assets and obligations for the liabilities relating to the arrangement, then it may be a joint operation as opposed to a joint venture entity, and that is where, but the legal structure has again a lot of importance. So how do you determine the legal form, the contractual arrangement, in substance test, etc. Some of that will help you to determine. But in our experience, if it is incorporated as a legal entity, most likely it will be a joint stock entity, and you will end up doing equity method accounting. If it is something which is incorporated as an unlimited liability, like a partnership, etc., it may continue to be a joint operations, and you will end up doing your share of revenue, your share of assets, your share of liabilities, etc., on an ongoing basis. So the important change is proportionate consolidation is going away under IFRS in that sense. Similar to IFRS 11, we've also issued IND AS 111. So again, similar change been made by ICAI as well, and not all, so we need to carefully evaluate the existing joint arrangement, communicate, because let's say if you're doing proportionate consolidation for a company, suddenly your revenue is going to go down significantly because of one-line consolidation. Equity method accounting is one-line consolidation. So we move forward to IFRS 13. IFRS 12 is largely a disclosure-related standard around joint venture, joint operations, etc. So we have IFRS 12 also, but now we'll move to IFRS 13 on fair value. So this is again a much desired standard which was issued by IASB, and this is also mandatory from January 1, 2013, with first annual financial statement is 31st December 2013. So this standard also significantly bridges the gap which today exists between US GAAP and IFRS on definition of fair value. So that way now both IFRS and US GAAP are comprehensively aligned in terms of what is fair value. So which is where we now have a single definition of fair value, and there's a framework which has been prescribed for measuring fair value, and the disclosure requirement for fair value measurement as well. So what is this fair value now under IFRS 13? Under IFRS 13, the fair value is something which is called as exit price. It's called as exit price and marketplace participant view. So if you have to value an asset, what it says that at what price you can exit out of that asset, and if it is to exit out of a liability, so at what value you can transfer that liability in a hypothetical transaction to an unrelated party, which is a marketplace participant. So it is important that the transaction is orderly, transaction is an active market, it is in between marketplace participant, it is not with related party, and it's a hypothetical transaction that what it will take for you, or what you will get if you have to transfer a liability, or what you have to pay if you have to transfer exit. How much it will cost you to exit out of that liability, or how much you will get if you need to exit out of that asset. So that's the fundamental concept around exit price and fair value, which is different from the present GAAP. Now, present GAAP, while you value an asset, you continue to value it based on exit price, but while you try to value a liability, you look at entry price, that how much I will end up paying if I need to take on that liability, and that is where you try and differentiate this, which is the bid and ask rate in a lot of situations. So it is now one common principle, which is the exit price, which is relevant. You may need valuation specialists to value some of the complex instrument what somebody may have. There is a significant amount of disclosure. So what it says that all your existing fair value disclosures you need to divide into three categories: category 1, 2, and 3. So category 1 is where you have valued something based on quoted market price. So let's say a stock which is listed on stock exchange, that is a level 1 evidence of the fair value. If you are trying to value something with reference to a comparable transaction, For example, you're trying to value real estate, and you know that some nearby location a transaction has happened, let's say 5,000 rupees a square feet. So you can possibly value your land with plus or minus 5,000 rupees square feet. So that's a comparable transaction valuation. So that is level 2 evidence. And then there is level 3, which is a lot of fair value is based on management models, management best estimate, etc., etc., for which you don't have objectively verifiable third-party data, and that is what is called as least reliable fair value. So you have level 1, level 2, and level 3. All 3 levels of disclosures required for each fair value instrument what you have recorded in your financial statement. So, so we need to look at the difference between current application and IFRS 13. If required, modify the fair value measurement process, and there are a lot of disclosures which are required. So we have issued 113 as well by ICAR. Let's move forward to, so we've talked about IFRS 10, we talked about IFRS 11, we've talked about IFRS 13. So one is changes around consolidation, the other one is changes around joint venture accounting, the third is changes around fair value assessment. Now we move to talk about some of the proposed standards. So these are all, what we talked about is 4 standards which are already mandatory now, which needs to be applied. Let's talk about things which are in the pipeline. So we'll talk about leasing. So leasing is a very, very important development which is happening in the field of accounting, and it's going to change fundamentally. The way we look at lease is going to change fundamentally. The good news is that the likely implementation date is not going to be before 2017. That's the good news. In terms of the bad news, is that most of the operating lease which you currently see, which are not recorded in your balance sheet, will now come to your balance sheet. So if any lease which go beyond 12 months, it has to be categorized into 2 types, whether it is for land or building, which is for property, then it is a type B lease. If it is for any other asset, then it is a type A lease. So there are 2 types of leases which have been defined, type A and type B. And for type A, let's say it is for the equipment, machinery, etc., or vehicle, for example. So all type A lease, whatever the MLP, whatever the minimum lease payment I need to make over a period of time, that I need to record in my financial statement. There's one good news here. So currently we see a lot of heartburn with our client to say, I don't want to record lease expense on a straight line basis. Okay. So what it will do, since you will be treating all leases as a finance lease kind of an accounting. Okay. So effectively in the early part of the lease, you will end up recording more because your interest cost will be more, and you will amortize the overall lease asset using an appropriate depreciation model. So in the early part of the lease, you will have a higher charge. In the later part of the lease, you will have a lower charge in your P&L. So you will no longer be required to do straight line method of recognition while you deal with a type A lease. But if you deal with a type B leases, which is your property and land and building, then effectively you will be required to use straight line method, if it is of the type of operating lease, and you don't record this asset on your balance sheet. So all type A leases will now come on your balance sheet, whereas type B leases will continue to be outside your balance sheet but to be recorded on a straight line basis. Similar change is for the lessors as well. So a lessor now will be required to de-recognize all operating leases which, let's say, go beyond 12 months. So effectively all type A leases, you will end up recording, you will end up removing your fixed asset, and you will record the lease receivable, you will record the residual value of your asset, and you will record the gain or loss if there is anything upfront, and record interest income over the lease term. So that's a fundamental change in terms of how you look at lease accounting. And it can change a lot of ratios. It can change your debt equity. it's certainly going to increase the size of your balance sheet. So a lot of companies which simply operate on a leasing model, operating lease model, all of them will end up grossing up their balance sheet big time. So this is a serious change which is happening, and as I said, US is also working towards a similar model as to what IASB has published, but the only thing is that the changes are likely to be applicable from 2017 onwards. So we still have some time to go before these changes become mandatory, but a lot of discussions is happening on lease accounting. Moving forward to change on revenue recognition. So under IFRS we have standard IAS 18 which provides you guidance on revenue recognition. Then we have IAS 11 which provides guidance on construction contract. Then we have a few Ifrs, IFRS 15 which is applicable for real estate. Then we have IFRS 13 which talks about customer loyalty. And then we have a whole host of other standards which provide guidance for revenue recognition one way or the other. For example, a separate guidance for insurance companies, some separate guidance for oil and gas company, separate guidance for financial instruments, separate guidance on leasing, etc., etc. So what the revised standard is trying to do, or the proposed standard is trying to do, is to give a very comprehensive framework for all revenue recognition related matter. Okay, a very comprehensive framework which is a 5-step process. So what it is going to do is that it will look at all contractual arrangement in terms of its substance, and look at the contract, look at what all obligations you are undertaking as part of that arrangement. You got to allocate consideration over each portion of your obligation. So if, let's say, an obligation is going to discharge at a different point in time, so how do you allocate consideration in a fair manner and then record revenue as and when each performance obligation is satisfied? So again, we are not sure of the proposed date of adoption of revenue recognition, of the revised standard on revenue, but again, a lot of work is happening on this. So many exposure drafts have been issued and reissued. Our kind of thinking is that this also may become applicable from 2017 onwards. So that's the second leg when we will see some of the new IFRS are going to be applicable and mandatory in that sense. So that's a big change which is coming in next 2-3 years. So revenue recognition may be accelerated or deferred. Revenue recognition may change from a point of time or continuously over time or vice versa. So a lot of judgment possibly will be required. A lot of fair value assessment will be required. So we need to look at substance over form for most of our contractual arrangement to determine revenue. It's going to be a very comprehensive framework for all types of revenue arrangements. So that's another change which is likely to come. The third is around IAS 19. So this is something which is is almost mandatory for companies to apply for. Which talks about how do you deal with actuarial gains and losses. Okay, so all actuarial gains and losses are recognized immediately now in other comprehensive income. So existing IFRS gives you a lot of choices for recording actuarial gain and losses. Actuarial gain and losses, let's say for example our gratuity. Okay, in a gratuity expense, what happens is that you go to an actuary and you ask the actuary to value your obligation, and actuary uses a statistical method which is called projected unit credit method. Now that projected unit credit method they uses certain assumptions. For example, what is your mortality rate, what is your attrition rate, what is your salary growth rate, what is the interest rate, what is your likely rate of return on investment, etc. So there are 5-6 parameters which are being used as an input by the actuary while measuring your overall employee obligations. Since these are estimates, estimates are bound to be different than reality. So when you go to the same actuary next year, then he try to actualize. Look, what was my estimate for my next year, kind of my future return, etc. What actually happened last 1 year, okay? Or what is the change for the way forward? So he's going to change some of his assumptions. Now, since he's going to change the assumption, the model throws a number which is related to actuarial, which is called as actuarial gain or losses. That means the change which relates to a change which arising because of change in assumptions. Now, under Indian GAAP, this is required to be recorded immediately into profit and loss account under AS15 model. Under IFRS, we had an option to record this immediately in the P&L. We had an option to record this in other comprehensive income, or we had an option to do a corridor method through which you can defer this amount and record this over a period of time. All right. So what they have done is, because of the change, now you will need to record this immediately in your balance sheet. Okay. This needs to be recorded immediately now into your balance sheet. So you are no longer allowed to do it through P&L. You are no longer allowed to do a corridor, but now you have to necessarily record this through other comprehensive income. Now this is consistent with India position on employee benefit under Ind AS. So at least, so we had an existing carve out. Now that is been in a way, with this change in IFRS, that difference is no longer in existence. So we managed to bridge this gap in that context. So this is a welcome change to my mind. This may impact the debt equity ratios of a lot of companies. However, this will reduce volatility in your P&L certainly, and also reflect all your obligation appropriately in the financial statement. Okay, so we've covered changes, some of the key changes under IFRS, on IFRS 10 on consolidation. We talked about IFRS 11 on joint venture. We talked about changes around investment fund entities. We talked about changes around fair value. Then we talked about changes on employee benefit obligations. We talked about some of the proposed standard on revenue and leasing. So now let's move on and talk about current Indian accounting and regulatory environment as far as IFRS, Ind AS, tax accounting, and other matters are concerned. So when we look at IFRS status in India, so we had the original roadmap of 2011, 13, and 14. We are already in 2013, so nothing kind of happened on that original roadmap. Some kind of activities happened, and based on our current understanding, that ICAI has kind of recommended to MCA, though MCA has not come out anything formally on this. What ICAI has recommended, that we should be looking at transition as April 1, 2015 for companies listed and unlisted net worth in excess of 1,000 crores. For 500 crore net worth companies, we look at 2016, and for April, and then for rest of the listed companies, we look at 2017. So that is where the proposed timelines are. Though, as I said, we don't know the status of MCA and what is their stand is going to be. We continue to see lot of uncertainty in this area, and we need to have more kind of clarification from them. But as you are aware, that SEBI has already allowed companies to publish financial statements using IFRS as a framework. So that is not Ind AS, but that is full-fledged IFRS, which is required and allowed. From an Ind AS perspective, Ind AS or IFRS converged accounting standard as issued by ICAI. We had approved 35 such standard on 25th of February 2011. We had carve-outs where we have deviation from IFRS, where we removed choices from IFRS, or there were certain optional deviation from IFRS. So we had some 4 or 5 major carve-outs from international IFRS to Indian version of IFRS in that sense. Subsequent to this, as I said, we have changes in IFRS happening. ICAI is trying to keep pace with all the changes, and they have issued similar Ind AS as what is required or what is issued by IASB. So some of that is kind of moving again in terms of its natural course. Let's move on to talk about tax accounting standard. Now this is something which again a change which triggered because of the proposed transition to IFRS in the country. You know, in the last quarter of 2012, where we all were waiting that government is now going to notify the date, etc., etc. There was a surprise to say that, hey, how are we going to tax these companies who now going to follow IFRS? Okay, will these companies be required two separate records under Indian GAAP or one under IFRS? Because, you know, end of the day, Ind AS was mandatory, let's say, only for 15-20,000 companies. And, you know, I just read a few days back that we now have more than 1 million companies in India. So, you know, how do I'm going to tax the rest of the companies in that sense? So again, a lot of discussion kind of happened around that. Ministry of Finance then got into action. They formed a committee. Okay, they formed a committee, and the mandate of the committee was to suggest accounting standard to be notified under the Act, suggest a method to determine book profit for MAT purpose, and amendments to the Act for smooth transition to Ind AS. So what all changes needs to be required under income tax law to make sure that companies are not unduly burdened with multiple set of accounting records, etc., etc. So that's the kind of key discussion which was happened and a committee being formed. The committee kind of worked on its agenda. They published 2 draft accounting standards to begin with, and then they published in total 14 draft accounting standards, which are still in the draft stage. So their strategy was is to look at all the Indian accounting standard, okay, all the Indian accounting standard, but they have not considered, say, AS 20, AS 30, 31, 32, which are not mandatory. So they decided not to consider those standards. Okay. Then they said some of the standards like AS 17, like AS 20 are disclosure only standards. So I don't need to consider them. Then they looked at standard like AS 14 on merger amalgamation. They said income tax law adequately provide guidance for mergers amalgamation. So I don't need to issue standard on that. Then they looked at standard like AS 21, AS 23, AS 27 on consolidation equity method. They say, my tax will continue to be on standalone basis, and hence I don't need to look at these consolidation related standards. So they looked at the overall basket of 32 Indian accounting standards, and then they issued 14 such standards. The comment period is over for tax accounting standard, and we are still waiting more clarification from the Department of Ministry of Finance as to the next step, that when these standards will become mandatory. If these standards become mandatory, then every company will be required that you need to have your primary books of account maintained in the Indian GAAP or Ind AS, as the case may be. Then you reconcile your books of account based on this tax accounting standard to arrive at taxable profit. I think that is where the key change is. So you don't need to maintain 2 sets of books, but you need to do a reconciliation as an approach to come to a taxable profit status. They have still not considered guidance note on share-based payment, revenue recognition by real estate developers, service concession arrangement, exploration and evaluation, because the mandate of the committee was restricted to accounting standards, so they have not covered the guidance note as issued by ICAI. So we expect some more clarification to come from Ministry of Finance in this area as to its appropriate implementation. Based on our current inputs, we think that as part of the direct tax code, they are most likely to introduce this as well as a concept, and over a period of time will become mandatory as well. Now we move forward to the last section of my presentation on key changes in the company's bill. So this is kind of very, very important in terms of the overall change, and going to impact a lot of companies, whether IFRS is mandatory in the country or not, because this is a change in the law, not in the accounting standard. and will become mandatory as and when company's bill becomes a reality in that sense. So I just thought to quickly highlight some of the key changes from an accounting and reporting perspective. So first change is mandatory consolidation. So as you know, under present requirement, AS21 is not mandatory if you are not a listed company. So it is only mandatory for listed companies under SEBI guidelines. So if you're an unlisted company, then it is not mandatory for you to prepare consolidated financial statement. The company's bill provide a mechanism that every company which has a subsidiary needs to prepare consolidated financial statement. So in effect, if you have multiple holding companies in your system, then you will need to prepare multiple consolidated financial statement for each such holding company. So that's a big requirement and a big change from the existing practice, and it has to be prepared in accordance with accounting standard and format to be consistent with Schedule 3 of the bill. All companies required to adopt this, all companies required to adopt 1st April to 31st March as the financial year. So this is a very fundamental change the way financial statements are being prepared. So we need to now look at consolidation as a mandatory requirement as and when this bill becomes effective. Moving on to fixed asset accounting. As some of you may be aware that under IFRS, for all my fixed assets, I need to look at component as an approach. So component as an approach is, let's say you have a big fixed asset which has several sub-assets which are part of that large asset. The current practice is to capitalize the asset as one category and depreciate over the mother asset useful life, let's say 20 years. The requirement under IFRS is to look at all the major components in that asset and amount or depreciate it based on useful life of each of the components. Now that is what is becoming mandatory through companies' bill. So even though IFRS or IAS 16 is not mandatory for Indian companies, or component accounting is not mandatory under AS 10, it is going to become mandatory through companies' bill. So that's another change. A lot of companies will be required to look at this. Some of these may have a transition guideline as well. So we need to look at the transition guideline, and this may have an impact in the immediate year in which you need to apply or in the following year. So we need to watch out for the rules under the company's bill, to assess what is the impact on this. Then we look at a statement of changes in equity. So currently, we prepare balance sheet, we prepare income statement, and we prepare cash flow statement, and then we look at all my disclosure schedules, etc., etc. So what the bill is saying, that along with your balance sheet, P&L, cash flow, you also need to prepare statement of changes in equity if applicable. So if applicable means that they are trying to link it to possible IFRS implementation in the country. So the law do contain a contingency to say, as and when IFRS become mandatory, this is also another statement which you need to prepare, which is required under IFRS. So a statement of stockholders' equity, which is what is the net worth of the company, what are the different components of the net worth of the company, all of that you need to prepare and disclose as a separate statement. That's another change. Restatement of financial statements. So, in the current scheme of things, when you discover an error or a fraud in a financial statement, what you do in the current period, you record that as a prior period item, and you move on. Whereas internationally, if you discover an error or fraud which pertains to the past period, then effectively you require to open your books for the previous period. You have to restate and you got to do the comparatives as if to the year in which the fraud happened or the accounting error happened. So that's a fundamental difference the way it is being done currently in the Indian GAAP and the way it is being done internationally. So that is a change they're trying to bring in through companies' bill to say restatement of financial statement. Though it's not mandatory under the company's bill, but the National Company Law Tribunal has the power, or the board has given that power, that if they desire so, they can require company to restate the financial statement. They can't go back more than 3 years. So there are some restrictions around it, but restatement is now a distinct possibility under Indian accounting framework as well. We move forward to utilization of securities premium. So Section 78 of the Companies Act, the present Companies Act, do provide a lot of flexibility on in terms of utilization of securities premium. So, let's say I have to pay premium on redemption of debentures. I have to pay premium on redemption of my preference shares. I have certain share issue expenses. I have certain reorganization related matters, etc., etc. So lot of cost which otherwise may require to go through P&L. Because of the existence of securities premium, companies may route those expenses through securities premium account. Now, what Companies Bill is doing is it is going to specifically prohibit the utilization of securities premium account for any item which ordinarily should have been recorded through income statement. So you can possibly now use securities premium account for issuance of bonus shares, for example, but you can't use it for charging redemption premium to securities premium account or charging your share issue expenses to securities premium account, etc., etc. So not significant change for utilization of securities premium. Then the definition of control, is undergoing a significant change under Companies Bill, and it is now more closer to the requirement of IFRS. So it's very comprehensive definition. This definition is now being taken from the current takeover code, which possibly will cover all scenarios in which the investor has the ability to exercise control or over the investing company. The big issue, which we're still not clear, that you may establish control and hence it becomes your subsidiary. But when in terms of consolidation model, will you follow definition of control under AS21 or will you follow definition of control under the Companies Bill? So, we continue to we expect that there will be more clarity on the subject as we move forward. But this definition is very wide and may impact lot of existing structure because whether or not we need to consolidate or not, if it is established that you control, lot more obligations now that may come upon a company because it is now my subsidiary, which previously was not recognized as a subsidiary. So that is where we need to watch out this space in terms of definition of control. In case of mergers, amalgamation, unlisted companies currently are not required to obtain a CA certificate. Okay, let me give you a perspective. So we do mergers, amalgamation under section 391, 394 of the Companies Act. As part of the merger application, I will write the potential accounting for such arrangement, and that accounting, once it is blessed by the courts, even though that is in deviation to accounting standard AS14 or normal principle of accounting, accountants or auditors are mandatorily required to follow this. All right. What SEBI did, sometime in 2009, what they said is that any scheme for a listed company which you file with the authority, you need to file it with me first, and that should accompany by a certificate from your auditor to say that accounting which is prescribed in the scheme is in conformity with the existing accounting standards. Okay. Now that was only applicable for listed companies. Now through Companies Bill, they are extending this to say not only listed companies but all companies who are undergoing merger, amalgamation, etc. The accounting which is prescribed in the scheme should be in conformity with accounting standard. I think that's a big change and will limit the ability of the company to write off or a lot of their hidden cost, expenses, etc., through a restructuring scheme. So that is where we need to continue to watch out this space. So this is going to definitely impact and this is again consistent with IFRS. So in IFRS, you can't account for the scheme just because it is blessed by the code. You have to account for the scheme based on the accounting standards, and that is where the change is going to be. Then the last point which I have on this is there is significant amount of focus now on valuation because there's a lot of noise around fair value, that whether we have the ability, capability, or the capacity, to do such fair value assessment and address it appropriately while preparing financial statements. So what government has done is that as part of the company's bill, they have made it mandatory for certain instruments where I need to use a prescribed valuer, okay? So there is going to be registered valuer for which the rules will come, the model will come that who is going to register, who is the authority who is going to regulate these valuers, etc., etc. So as and when that kind of becomes applicable, so certain such instrument needs to be valued by these registered valuers. So that's an additional compliance cost, of course, on the company, but it may help in bringing some consistency the way fair value principles are going to be applied by Indian corporates in general in that sense. So that is what I had as part of this discussion. So to quickly kind of summarize, we talked about IFRS 10 on consolidation. We talked about IFRS 11 on joint ventures, where it say that proportionate consolidation is no longer allowed. We talked about IFRS 13 on fair value, which says that you need to use exit price as a mechanism for valuing all instrument under IFRS 13. Then we talked about changes in employee benefit obligation, which says that your actuarial gain or loss needs to be recorded to other comprehensive income. We talked about changes for investment funds. Then we talked about few proposals on revenue recognition and lease accounting. Lease accounting is going to be extremely different than what you see today, and lot of leases which are currently off the balance sheet will now be on the balance sheet. But the good news is that these standards are still far away in terms of 2017 as the possible timeline, but may have significant impact on the businesses. Then we talked about some of the present status of IFRS, Ind AS, tax accounting standard from an Indian context, and of course the possible alignment, from a company's bill perspective, whether or not IFRS or Ind AS become mandatory in India or not. So that is what we've covered as part of this. So I'm now going to take questions, and if you have questions, you can write to me, and I will try and address a few of your questions as well. So anybody who wish to ask any question on what we talked about, then I can take up. You need to type that question